The 1% rule is where the property's monthly rental value is equal to 1% of the purchase price as well as any renovation cost. But let me tell you why this isn't always such a good rule of thumb. What's up, you guys? My name is Antoine and welcome to my channel where I like to talk about things like real estate, investing, as well as lifelong learning. And if that sounds good to you, be sure to hit the subscribe button down below and turn on the bell notifications. And in this video, I'm going to be talking about what I mentioned before, the coveted 1% rule in real estate. Like I mentioned before, simply put, say you buy a $100,000 property and you're looking at rents around the area and you're seeing that it could rent for $1,000 a month. So that follows the 1% rule. And if it follows the 1% rule, then it must be a good deal and there's no point in doing any other further research. Real estate's pretty easy. I'm just kidding. No, it's not at all. Not at all how you should do it. In my personal opinion, the 1% rule is more of a screening process as opposed to hardcore what you have to use and then it's fine, you can buy the property. You're really just trying to quickly gauge how much market rents are going for versus the actual price of the property. But pretty much the rule gets kind of funky after you get over a $250,000 property to where it doesn't necessarily need to follow the 1% rule in order for it to actually cash flow positive. Because when you're purchasing properties, there's a lot of different factors that you should consider. Like say if you bought a property that's worth $50,000 and it's able to be rented for $500 a month, but it's in a tougher area, the property would meet the 1% rule, but since it's in an area that might have more wear and tear on it, then you're going to have to cut into your profits in order to actually make those repairs to where it follows the 1% rule, but you also could be losing a lot of money on the property. But the one rule that always works in real estate is pressing the like button down below. As opposed to like the example I mentioned before, if you buy a $250,000 house with a 30-year fixed mortgage at 3.5% as the interest rate and you put 20% down, you're looking at about $1,500 a month all in for your mortgage. And that's not including your capital expenditures. And if you're renting it for $2,000 a month, you're not meeting the 1% rule of renting it for $2,500 a month. But you do have that buffer of all in at $1,500 a month versus the $2,000 a month of a spread of $500. So as the properties start to climb in value above $250,000 to $500,000 and it's a multifamily, then yeah, the 1% rule doesn't really make sense, but the property can still be cash flowing a good amount. And we're not even talking about appreciation yet, but that's for a different video. As an investor, you'll hear all types of rules in real estate that you should follow, but in reality, they're just a high-level analysis of how well the property would actually do. But when you're really closely looking at a property and you're actually trying to analyze it, things you should actually look for are the population and employment growth of the area, your risk tolerance if you're buying properties in a more dangerous area, the location, and real estate's all about the location and proximity to amenities, and how much rental demand there actually is in that area, just to name a couple things that you should be considering. So that really quickly is what the 1% rule is in real estate, in my opinion on it, kind of saying where after you get over a $250,000 per property, it doesn't really make sense as much anymore because you're still able to cash flow. As always, you guys, thanks for watching this video. Be sure to share this video with someone you think could benefit from learning about the 1% rule. And be sure to give this video a like so you can help me help the YouTube algorithm push this video. And I'll see you guys in the next one.